Hello everybody. Today we discuss about the effects of the coronavirus pandemic on banking sector in India. Likely impact. Banking sector in India was already reeling under tremendous pressure, and to compound problems, the random shock of this virus attack has affected banking insofar as it has primarily affected the borrowers and other customers of the banks. So we are looking at, or rather staring at, record drops in activity. The International Monetary Fund has said that India will grow at the most at about 1.9%. Remember earlier we were growing at 7%, 5.5%, and now to fall back to 1.9% is something which will affect everybody in the system, economic system. So banking has to bear the brunt of this unprecedented onslaught of the virus. There's going to be a sharp reduction in employment. People are not going to be able to pay mortgages. 23 to 24% unemployment rates in the organized sector. The unorganized sector has a lot many problems coming back. Migrant laborers are going, and therefore you're going to see a very slow return to pre-pandemic levels. And this is going to affect the banks. The Reserve Bank of India has tried to bring in more liquidity into the system, has tried to lower the interest rates through its transmission mechanism of the repo rate. But yet, the salutary effects of any such move will take time. The net interest margin of banks will be under pressure in the interim. And as mentioned earlier, Indian banks had already been under pressure. Public sector banks had a non-performing portfolio of 7.4 lakh crores. Private sector banks had 1.84 lakh crores. Foreign banks had only 12,000 crores. And aggregate to the scheduled commercial banks, all according to the Reserve Bank of India's trend and progress in banking, was 9.36 lakh crores in 2018-19. That catapulted us to the first among the major economies in non-performing assets, a categorization we would rather not have. 9.1% of our total advances are stuck as non-performing. The nearest that comes is Italy, which is at 8.5%. China, who is seen by us, by several of us, as a competitor, is only at 1.8%. Even presuming opacity in their figures, even if you double it, it comes to only 3.6, whereas ours is at a yawning 9.1. Some estimates pre-pandemic is 9.5. And I'm sure that with the pandemic problems, we are going to see a further fall, not just to double digits, but to quite a substantive escalation, as all the large sector, the medium sector, the services sector are all affected in the pandemic. You cannot be better than your customers. So banks have to be as good as the customers, and that's going to affect us. The United States, many people say, is a weakening economy. But let me caution you that non-performing assets are only 1% according to Bloomberg there. Just 1% of the total assets. Write-offs, which has been a major controversial subject in more recent days. When 68,600 crores was written off the 50 top willful defaulters in the Indian banking system in September 2019. Let us remember that that is not a sudden development. Last year, the Indian banking system wrote off 2.37 lakh crores. Every year, technical write-offs are there. Public sector banks wrote off 1.83 lakh crores last year. Private sector banks 49,000 crores. Foreign banks only 4,000 crores. Now these are figures which could be perhaps defended as technical write-offs. A technical write-off is when you do an accounting write-off to facilitate the books of the bank to factually reflect the performing asset criteria. So you absorb the remaining portion and take your bad debts off or potential bad debts off. And then you wait for it to come back. As and when it comes back, if there is recovery, it will go to the profitability of the bank. So any technical write-off perhaps signifies a good accounting procedure. Not perhaps, definitely, it signifies a good accounting procedure and should be welcomed. But the ability of the banks to withstand such credit shocks repeatedly is a problem. Our dependence on the largest sectors are becoming problems. On the largest corporates are becoming problems. Our early warning signals are perhaps not working. And I see a withdrawal of the micro, small and medium enterprises from the banking sector in the September 2019 figures. Medium enterprises credit offtake fell by minus 6%. Whereas the Indian banking sector had lent, the scheduled commercial banks had lent substantively to the non-banking financial intermediaries. The non-financial banking companies are actually your competitors, and yet you lend them money for onward lending, adding to a layer, adding to your competitor making money. There was a 35% increase in the September figures of lending. That means that there was some sort of a dereliction of duty among the bankers who sat tight, giving money to the big customers and money to the financial intermediaries, and then decided that the retail portfolio will be handled by the non-banking financial intermediary. Even the Reserve Bank seems to have come up to that point, because in order to protect the medium, small and micro enterprises, and the non-banking financial intermediaries were given liquidity of up to 50,000 crores recently. So that being so, we'll have to rethink banking post-pandemic. We need to get the retail portfolio moving again. We need to support the customers who have either fallen by the wayside or are likely to fall by the wayside. We need to look at what are the possible ways in which we can counsel them, negotiate with them, talk to them, and get them on feet. A moratorium of 3 months is inadequate and insufficient, perhaps. We have to have still the repayment or freeze the repayment, some standstill for 1 year or so, both for interest and for repayment of the moratorium. So the moratorium has to be of the principal, and the interest payment may have to be deferred. There has to be a reconstruction thought of. Ideally, Small Industries Development Bank of India will reach out, but that by itself may not be sufficient. We need to have something like the post-World War II Bank for Reconstruction and Development, because in extraordinary times there are extraordinary solutions. So we really need to rethink our approach of bringing back the retail portfolio. That does not mean that we keep the bigger customers away. In banking, it is well said. As an ex-banker, I would appreciate that substantive portion of my profits, maybe 70 or more percent, may come from 20% of my, we call it the 80-20 principle, where all are equal, but some are more equal. So 20% of my customers might give me 70% of my business. I recognize that. But yet I would feel that the vulnerable sections in a financially inclusive society, the asymmetric impacting of COVID on the vulnerable sections may be more. Ability to withstand credit shocks, and therefore we need to support them. We need to bring the customers through counseling sessions. We need to have a dialogue with the wealthier, high net worth customers on an ongoing basis. We need to have innovation as an imperative because it's a digital world. The new normal is digital. It is not optional anymore to be manual. Even the new normal is work from home, and that makes us think. In banking, we thought about working in places, but then video teller machines which have come up in the United States, in Singapore, show that the customer can contact us face to face with a teller, even at midnight if necessary, through the video based teller machine. But that needs capital investment. So the bigger banks may be in a position to switch over. So that bank which is able to meet the requirements of the customers, the purpose of the existence of any organization, Peter Drucker said, is the customer. So we need to ask the customer, what does he want? How can we support him? How long will it take for him, big or small, to come back? To enable him to do that, we need to improve ourselves. JP Morgan Chase decided to close down 20% of its branches to cut costs, obviously. And therefore, you will have reduced staffing. We need to think. The restrictive policies of yesteryear may not work. We need to think about whether we really need so many staff members where the productivity is not so good. The ultimate responsibility of the banker is to the shareholder, apart from the stakeholders. So therefore, the owners have to get a return for their investment. Return on investments in Indian banks has been very low, as you know. It cannot be. So cross-training for our staff have to be geared to meet the challenge of digitalization. Do we really need a recruitment system that is generic? Or we need a specialized recruitment system? Can we have less costs by tying up with management institutions, telling them what banks really need? Can we have a management program which is suited for the banks? Can we have analytics as an integral part of such a management program? And we are talking in terms of credit analytics, we are talking in terms of foreign exchange matrices, we are talking in terms of these very many approaches of digitalization. And that needs us to think in terms of, do we need more of engineers or do we need literature students anymore on banks? Human resource analytics have to rethink. And I think that we would be needing sophisticated equipment and equally sophisticated staff members. If HSBC can think of dispensing with 35,000 employees to bring up bottom lines, why should we lag behind? Of course, HSBC has since decided, because of the pandemic problem, they have decided to defer. But obviously, the best bankers are going to be those who have the least costs. So a revolving door policy where a lesser costing, more efficient, productive, having more positive impact on profitability versus the restrictive practices of yesteryears have to be thought of by banks. Digital mass cannot be stopped, and therefore we need to be. Wealth management techniques have to be sophisticated. Personal financial planning for a society that is hit hard by the severity of shock, a physical shock, a medical shock. We need to think. We need to think of how do we counsel our customers. Real-time support to affected customers are needed. Encouraging digital migration of the larger customers. Keeping clients engaged via SMS, via email, talking to them. I waited for my banker to call me to ask how am I. Though I may be a nobody, every customer has a right to expect his banker. So relationship banking has to be built in for the high and the low in the system. So we have to serve all categories in a manner which will push us up into making profits and costing less to the taxpayer. I think the pandemic world has brought us to a standstill. Post pandemic, we will revive. Our ability at resilience will be challenged, and the best banks will be those who can rise up to the challenges in the quickest time possible. Thank you so much.